Hello, Business 330 students. This is Professor Hassey. It's the weekend, Sunday, June 12th, 2022. This is my week number 1 update video, and I'm a little late this week. I'm sorry. I've had some tough times with the computer systems lately, and I had to reboot and get everything organized yesterday. So I'm a little bit behind this week, but it's the first week, so I'm entitled to that. But what we do in this class, and as I explained it to you in our introduction video earlier this week, 2 videos every week, usually on Monday and Fridays. The Friday one is the weekend update. And that's what this video is. It's the weekend update of week number 1. You have a assigned, assessed work this week, the discussion post, where you are to show me your Blackboard skills and also show me your skills with creating a spreadsheet and showing me a portfolio of stocks totaling $100,000. And that is all due at midnight this Sunday, June 12th. Please make sure you complete that work and post it by midnight. After midnight and tomorrow, when I start creating our week 2 video, I'll review all the work posted and post the grades for that first assessed week. But our topic this week is what is finance and what is business finance, corporate finance. As I explained on Monday of last week, it's the study of maximizing value of a company through the use of assets and capital fundraising. The capital fundraising, there are 3 ways of getting capital, cash for a company: borrow it, issue equity ownership, and make a profit. And these 3 sources provide assets. You purchase assets, equipment, building, land, people, R&D, products, and those assets produce revenue, cash flow, profit, and those cash flows make the company pay off those investors, the bankers, the bondholders, the stockholders, the hedge fund managers, and also make the company grow. And that's what finance is all about. So this first week, let's talk about the definition of finance and what it means for you all in your business administration program. One of the key things about studying finance this summer in our 8-week class is to make sure you can apply to specific companies or corporations like in your portfolio, but at the same time understand the whole macro view of finance, the Federal Reserve, social, political, economic issues around the world. All these interplay with each other throughout the study of corporate finance. Corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision-making if the corporation is to maximize profits and stay competitive for future success. Capital budgeting is, and we'll be studying a lot of capital budgeting in weeks 4 and 5. Capital budgeting is the investment in an asset going to prove a return over and above the cost? And how are you financing that capital investment is the capital structure of your company. The capital structure of your company is what debt and equity and profits have funded that investment in assets. To manage all these effectively will maximize the return to your investors. That's finance. And there's 3 basic principles in finance. The investment principle, meaning very simply, you want to make more money than what it costs you. The investment principle, you want to earn a return over the hurdle rate. What's the hurdle rate? It's the cost of your money. It's called capital cost. In other words, if I go out and borrow money at a bank and they charge me 6%, and I take that money and invest it in an asset, and that asset returns to me in cash flow and profit 4%, I'm going against the investment principle. Why? The money is costing me 6%, but I'm only earning a return of 4%. I'm losing. So the investment principle, to maximize the value of a firm, you have to earn more than what it cost you. The financing decision, that principle is what mix of debt and equity are you going to use to finance that investment? Because many times you cannot borrow money. You're going to have to finance by issuing equity, going on Shark Tank, issuing stock, going to a hedge fund, investment bankers. Because debt, though cheaper than equity in cost, is influenced by the credit of your company, your credit rating. If you have bad credit, it might be very expensive to borrow money. So we're going to talk a lot about that in this class, that mix of debt and equity that finances a company. And then finally, the dividend decision principle. How do you distribute the return to your investors? Now, naturally, if you're borrowing money, you have to distribute it or you're going to be in default. So you got to pay interest and principal. But in equity, how you divide or distribute in return is either in the appraisal or the market value of your company going up through the increase in stock price, or pay a dividend. Well, sometimes companies decide not pay dividends and keep that money to reinvest back into the company. But then you're going to get shareholders very upset. They're not getting some liquidity out of their investment. So this is another important principle of finance, is how do you distribute the return on the investments? The three principles to maximize the value of a firm: investment, financing, dividend. There are three forms of organizations in finance, and many of you are probably familiar with this. There's the sole proprietor, where you have one owner. Both the manager of the company and is the owner are the same. A partnership, where again, the managers of the business are also the owners, just multiple owners in a partnership. And then the most common entity that we'll study in this class, the corporation, where in the corporation, the managers do not own the corporation. The corporation is owned by the stockholders. The managers work for the stockholders. The main difference between a corporation and a partnership and a sole proprietor is most corporations, publicly owned corporations, the managers work for the shareholders. Sole proprietorships and partnerships, the managers are the owners. Also, another key reason why corporations are the largest holders of capital in the world is because they have limited liability. Meaning, if you sue a corporation, you only sue the assets of the company. You do not sue the individual owners of the business. If I own a share of stock in Apple, and Apple screws up and gets sued by a client or a customer or somebody, or by the government, if Apple loses that, they have to sell off assets or take money from their cash flow to pay the settlement. But I, as an owner, do not have to sell my stock or pay any money into that settlement. That's the main difference, limited liability. Whereas in a partnership and a sole proprietor, they have unlimited liability. In other words, if I sue a partnership or a sole proprietor, I can also sue the assets of that company or that business, and also sue the owners. That's awfully risky if you're running a sole proprietorship or a partnership. That's why these days, most companies who are small business, like proprietorships and partnerships, become corporations in what is called a limited liability corporation or a limited liability partnership. Both these are corporations, but they're run like proprietorships and partnerships. There was a change in the tax law in the late 1990s that allowed for this. So the two main difference in why you want to invest in a corporation is because of limited liability, and you don't have to run it. You pay somebody else, or you designate somebody else to run the company. And why do we invest in corporations? Because they take capital, stock, debt, profits, and they invest it in growth. Because of the competition in the market. If you don't invest in new assets and grow a business, your competition will get larger, and you'll eventually, over time, go out of business. You maximize the value of a company by growing and using capital to do that. But at the same time, you want to maximize value and make profits. But at the same time, you want to also accept and understand your responsibilities of a company. Ethical responsibility to society. Do you pay women equally as you do men? Do you treat the environment with respect? Do you not pollute the air or the water? Do you manage your business ethically? That's a main objective in today's business. Not only naturally make profits, but also is your company represented by fairness? Ethically, you make decisions that are right for the world. That's another important objective in corporate finance. So in this case, my high-tech slide of the week, this manager is jumping up and down to see, okay, what does it take to maximize that shareholder profit? What do I have to do as a manager to make money? But at the same time, what are my responsibilities to my employees, to society, to the environment? What balance should I make as a manager to achieve all these goals in addition to making money? One of the big highlights we'll talk about, and remember when I talked about it in my very first, or one of my investment principles, is the hurdle rate. What does it cost us to get the capital? If I want to go out to dinner tonight and I have no cash, I use my credit card. Okay, no, that's short-term debt. I use my credit card to go out to dinner. The cost of that capital is if I don't pay that credit card balance in 30 days, I will have to pay interest on that transaction. And roughly most credit card debt these days have run anywhere from 10 to 25% on the outstanding balance. That's the cost of that capital. Me opting not to pay in cash and me not opting to pay that money in within 30 days, my cost of that money is the interest rate on the debt. It's called weighted average cost of capital. The weights of a company's capital structure assign the cost of that money, cost of equity, cost of debt, to equal the cost of capital. And it's many times this is called the discount rate, the hurdle rate, the opportunity cost, the cost of capital. Very important concept in finance. And also we have to understand the conditions that affect money or capital that we work in. Economic conditions, like what's going on right now. Inflation. Inflation is 7 to 8% now. It's a lot more expensive to do business these days. Internationally, what's going on in the Ukraine right now and the price of oil? Anyone buy gas lately? What's going on with our relations with China, with India? What's going on with our relations with South America? All these international issues, economic issues, play into our, as one company, dealing with the conditions of running a business. All in the area of the financial markets. The financial markets is where we go and get the capital, where we represent our business to people who are thinking about investing in us, bankers, investment bankers, bondholders, stockholders, hedge fund managers. All kinds of institutions, you go through the market to get this capital. Some of the physical locations of this capital are in New York City, the New York Stock Exchange, one of the exchanges you're using in your portfolio. But there's exchanges all around the world. There's an exchange called the Chicago Board of Trade, is where you can purchase and get money in the commodities markets. And then there's digital markets, the Nasdaq, another exchange in your portfolio. There's no physical location for Nasdaq, it's done electronically. Now the New York Stock Exchange is done electronically too, but there's a physical location. Matter of fact, if any of you ever go to New York and you're a business student or have a business degree, you should go spend a couple hours down at Wall Street. Take a look at it. It's kind of cool. The financial markets. And the financial markets are all designated to generate this. The Franklin, the $100 bill. Generate capital. Turn $100 into $200. Turn $200 into $300. The cash needed to fund businesses and growth. But in our economy today, there's competition for these American dollars through China, through Britain, through Japan. And one of the key ways of determining the relationship of the economy and social and political issues to our own individuals in our markets is from these key economic indicators. And I track these. I've been tracking these for 40 years. 9 indicators that talk about equity markets, credit markets, commodity markets, currency markets. All necessary to watch if I'm running a business, or also all necessary if I'm running my own personal finance. The Dow Jones Industrial Index, the Standard & Poor's 500 Index, and the Nasdaq Index, all defined in the first 3 weeks of our Blackboard, all part of our portfolio. They're the leading indicators of the markets. Looking at it at different ways. The Dow Jones is looking at 30 designated companies in the market. The S&P 500 is looking at 500 stocks around all different industries in the market. And the Nasdaq is looking at 2,500 mid-sized to large-sized corporations in the market. And take a look at this indicators. Note how they've gone down quite a bit since the end of last year. The equity markets are down about 20%. The markets have dropped. Inflation, world events. If you own stock in the last few months, you've probably lost some money. In my own personal portfolio, I'm down about 22%. Ouch. But this happens. You got to be prepared for that. The 10-year United States Treasury yield. If I go today or tomorrow morning, Monday, and take $1,000 out of my bank account at Wells Fargo, and I go out and buy through Wells Fargo a $1,000 United States Treasury bond for 10 years. For the next 10 years, every year, I'll get a check from the United States government for $29.55. And at the end of those 10 years, I get my $1,000 back. Now you might think, boy, that's a kind of a lousy investment, Mr. Hassey, especially these days. You're making 2.955% when the inflation rate is 8%. That doesn't sound very good. But here's the key. It's risk-free. There's no way that I'm going to lose my money, my principal, because it's backed by the highest credit agency in the world, the United States government. If they can't pay me my $29.55 next year, they'll just print more money. Now, overall, that incites inflation, but I still get my money. Apple Computer could go broke. It probably won't, but can they print money? No. Can Amazon print money? No. That's why it's called a risk-free investment. I'm going to get my money. But notice how that has changed in the last 6 months. Inflation, it's almost doubled. Inflation. That tells you something about the cost of money. When the United States Treasury yield goes up or down, that affects credit card debt, mortgage debt, bond debt, all kinds of debt. That's the staple of debt. Then you have the 2 leading commodity indexes or rates, crude oil and gold. Crude oil kind of drives us every day, buying a tank of gas, paying for heat or electricity. And notice how crude oil is up quite a bit this year. Gold up just a little, but gold is a major commodity because people use gold as a hedge. It's liquid, it's secure. So if you think the markets are going down or it's not, you have no other good places to put your investment dollars, you buy gold. It's safe. It's liquid. You can sell it quickly. The two leading commodities. And then finally, the three major currency evaluations in the world. The euro to the United States dollar, the United States dollar to the Chinese yuan, and the United States dollar to the Japanese yen. How the US dollar does to these various currencies. The dollar has gotten a little weaker over the course of this year, but it's still the strongest currency in the world. If you're doing business overseas and the dollar goes up in value, it makes your goods more expensive overseas. But it means the goods coming into your country as imports are cheaper. Currency is what we're going to also be talking about a little bit in this class as well. So what I ask you during the course of this class, and if you want to, as business students, you should get familiar with these indicators, what they tell you about how current events and the markets are changing. Can they give you an idea of what's going to happen in the future? These key indicators are very good guides to study finance. Because the world is changing. Remember, I mentioned earlier that the United States dollar, the 100, is the main form of currency in the world, but the world is changing. This is the Chinese yuan for $100. There are competitors, both socially, politically, and economically. We have to do business with them, but at the same time, we have to compete with them. Every business in America, like it or not, you're influenced by what happens in China. So that's a good little PowerPoint that's also included in our week number 1 that gives the basics of what chapters 1 and 2 are all about. The definition of finance and the financial markets. Next week, when we study week 2, we'll learn about how financial statements and financial analysis, what accounting data tells us in relationship to finance. But the key thing for us this week is to just get up to speed on Blackboard, give me an assignment that shows me you know how to use Blackboard, and just get the basics of our course. Remember, our Blackboard is set up with the course announcements, course information, Zoom and YouTube links, our discussion forum, where you can ask questions at the same time do any discussion work like this week, and the weekly folders, where I list the learning assignments and information on the study and topics of that week. So please make sure you're aware of this, you're studying this, because this is online. This is remote learning. You're on your own with a lot of this study. The videos of Monday and the weekend update videos are there to help you, guide you through these. We have office hours. And also, you can contact me at any time if you have any questions or concerns. So as we complete this first week, I'm anxious to look at your portfolios, your spreadsheets, and hopefully you got a grasp of what we're doing this summer in business finance. So thank you, everybody. Have a great weekend, the rest of the weekend, and I'll see you in my week 2 video Monday afternoon. Until then, adios.